Well, now we talked earlier about Facebook and Mark Zuckerberg's much anticipated address. Facebook's share price recovered quite a lot, actually, on hearing from Mr. Zuckerberg, but the thumbs-down reaction of the market to the Cambridge Analytica scandal earlier exposes just how vulnerable investors are to the high-tech US stocks and, indeed, the ETFs that track them. Well, that's the view of fund manager Roger Montgomery, who's just written a very interesting paper on this. Roger Montgomery from Montgomery Investment Management. He joins me in the studio. Hello, Roger. I was just really interested in some of these numbers for the last quarter of 2017 and what's happened to PE ratios and what's happened to the...
So the S&P has, in the last 9 years, risen about 331%, give or take, depending on the day.
Yes.
And to contrast that, we've got, for example, Netflix, which is up about 5,300%. We've got Amazon up 2,200%. Amazon's on a PE of over 200 times. Netflix on a PE of over 300 times. Now, all this has happened, of course, because there's been enormous enthusiasm, if not euphoria, around how these technologies are going to change the world, whether it's the sharing economy or 3D printing or artificial...
And trust in these technologies as well.
And belief that nothing will go wrong and that they'll change existing business models without interruption. We'll come back to that in just a moment. But what's actually happened now is we've got a situation where we've got some of these indices, for example, the FANG Plus index, which has the FANGs in it and NVIDIA and a couple of other stocks, Tesla included. It's on multiples now that are 3 times the broader market, and that spread is even greater than during the dot-com boom. What people haven't realised or haven't expected in their projections is that, one, there could be interruptions to their growth models because some of these businesses don't make any money. Tesla, for example, delivered between 90 and 100,000 cars last year. It's got a $50 billion market cap. Ford, on the other hand, has a $44 million market cap, and it sold 6.6 million cars. So you have these very high expectations built into the price of these companies, which has driven them high. Now, the consequence of that has been the ETF weightings to these companies.
How much, just take it back a step for me, how much of, say, the growth index does big tech in America?
So the S&P Growth Index is 49% weighted to technology companies.
49%?
49. The Russell 1000 Growth Index is 39% weighted to these tech companies.
So if you're tracking the index...
Well, you're really not diversified at all. You really do have an enormous active weight, about a 60% active weight versus the S&P 500 to technology stocks in some of these growth indices. And it's the momentum trade in the growth index that these ETFs have been forced to buy because as these companies get bigger, of course, their market capitalisation goes up, their weighting in the index goes up. We've now got about these tech companies, the biggest 8 tech companies have a 50% weight in the NASDAQ and a 15% weight in the S&P 500. So they have an enormous weight. Now, the problem, of course, is the indexes are heavily weighted to these. Their turnover is significantly higher than the turnover of the underlying stocks, which of course is fine when the market's going up because you've got Vanguard and State Street just gradually feeding in the money that's flowing in to the ETFs into the market. And that's why up until February this year, we saw a record number of days without a 1% fall in the market because there was just a gradual inflow of cash. But what happens when these indexes that have up to 3,000% turnover in a year, and people start pulling their money out of these indices at 3,000% velocity, and the underlying holdings only have 90 or 100% turnover? For example, Apple, which is the biggest holding in many of these ETFs, it turns over only about 105% a year. So you're going to find that jaws are going to open up between the ETFs and the tech stocks. And people haven't anticipated the regulatory
So what does that mean? What will happen?
So what will happen, of course, is that even if the stock market is only down, let's say, 10% or 15%, sharply, of course, what you could see is these ETFs fall significantly more, 20 or 30%. And in fact, in August 15, we saw the high yield index, the HFY ETF in the United States. It fell about 30% in a couple of days, despite the fact the underlying portfolio was only off about 5%. So, and now, of course, we've got Zuckerberg in front of the Senate.
Yes.
We've got the Democrats talking about a new midterm election campaign or a new economic agenda.
With all their antitrust ideas.
With all the antitrust ideas. We've got Uber now in trouble, being fined by the EU.
On the nose all over the place.
Exactly. We've got Airbnb being hit by new regulations for hosts, and it just goes on and on and on. People haven't anticipated this. The prices are really high, and they're stuck in them through ETFs.
Right.
It could be the source of the next violent bout of volatility.
Roger Montgomery always giving me the shivers when we talk like this. Right, but thank you very much for all of that. After the break, why biotech should be excused from the government's R&D tax reforms. I speak with Oz Biotech CEO Glenn Cross.